To the casual observer, the stock market often appears chaotic, a game of chance resembling a spinning roulette wheel. But for those individuals building massive wealth, the volatility disappears behind a rigid grid of logic and data. Rakesh Jhunjhunwala began his career with 5,000 rupees. By the time of his passing, he had translated that modest sum into a capital base exceeding 40,000 crore. This trajectory began in 1985. At that time, the Sensex benchmark was struggling at a mere 150 points. Jhunjhunwala approached this environment as a master strategist, applying a repeatable roadmap that prioritized fundamental research over speculative luck. His success serves as a case study in how a logical vision can systematically outpace the randomness of the crowd. The first layer of his strategy involved identifying high-quality businesses that the broader market had temporarily underpriced. In 1985, he targeted Tata Tea. He looked past the fluctuating share price to analyze the factory output and plantation yields, betting that the company's physical productivity would eventually force the market to correct its valuation. The thesis proved correct within 90 days. As the market recognized the company's strength, his initial investment tripled in value. He applied this same scrutiny to Titan in 2003. By analyzing consumer demand and brand strength, he acquired a massive stake in a business the market had largely ignored. Many new investors bypass this level of detail, instead chasing low-quality penny stocks based on hearsay. They ignore the balance sheets and management quality that actually drive long-term price action. Real profit is found in the business behind the ticker, rather than the movement of the ticker itself. Maintaining these positions requires a specific psychological profile. Sharp market crashes and extended periods of high volatility are simply fundamental, unavoidable characteristics of the stock market. This diagram illustrates the anatomy of a crash. When the market drops, most investors emotionally break and liquidate at the worst time. But Jhunjhunwala viewed these crashes as moments to acquire high-value assets at a discount, maintaining his positions while others fled. This conviction was supported by a strict protocol of risk management, the direction, but risk management provides the staying power. The final component of the blueprint is the timeline. Jhunjhunwala often described his philosophy as buy right, sit tight. His wealth wasn't the result of active daily trading. He held his most successful assets for over 2 decades, allowing the underlying business growth to compound year after year. This curve demonstrates the math of compounding. Returns remain modest for years before aggressively arching vertically. Multipliers like 50x or 100x only appear at the far right of this timeline, multi-bagger returns reserved exclusively for those who refuse to sell early. In the math of wealth, patience often contributes more than intelligence. Even without massive starting capital, this framework can be implemented by any individual starting today. The process begins with establishing a technical foundation through a reliable DMAT account. Next, an investor must learn to interpret 3 critical gauges of corporate health: the PE ratio, return on equity, and debt to equity. These metrics reveal if a company is overvalued, how efficiently it generates profit, and if its growth is funded by dangerous debt. For those building capital from zero, systematic investment plans, or SIPs, allow for a disciplined entry into the market, regardless of short-term price fluctuations. A series of consistent, research-backed actions will always provide a more stable foundation than a single emotional gamble. This strategy relied on a central premise, that the specific companies Jhunjhunwala analyzed, like Tata and Titan, would inevitably grow alongside a modernizing Indian economy. He viewed individual balance sheets as small pieces of a much larger national expansion. As the Sensex climbed from 150 to over 15,000, his research-backed bets on Indian productivity paid off. He bridged the gap between raw data and massive wealth through continuous learning, constantly reading annual reports to find the next business that would benefit from this economic tailwind. These modern skylines represent the culmination of decades of disciplined capital allocation. The stock market remains a massive repository of wealth for those willing to exchange the excitement of a gamble for the